Let's talk about, what standing pat, or for what standing pat on interest rates mean for the fixed income markets. I hope that made sense. Let's bring in one of Bloomberg best. That means we bring you only the best people on the economy. We've crunched the numbers to find the most accurate forecasters in the world. One such person is Guy Lebas. He's chief fixed income strategist over at Janney Montgomery Scott. Guy, good to have you back with us. So let's talk about this. I mean, you actually were expecting some changes in the language, so you were a little bit disappointed here.
We were really expecting the Fed to not necessarily drop, but really downgrade what's become phrased as the extended period language. In truth, this language hamstrings the Fed. It handcuffs them. It prevents them from acting for a good long time. Well, an extended period, to use the same phrase. And I think that's going to become a problem, particularly as we move into the second half of this year. They're going to need a lot more flexibility.
Yeah, Guy, I loved your note on this. It was a great Monty Python reference regarding the ending of the programs. You want to repeat that, by any chance? Shuffling off the mortal coil?
Sure, absolutely. I have to dig out the old the parrot reference. The TAF kicked the bucket, the TALF shuffled off its mortal coil, and CPFF ran down the curtain. The truth is, these emergency support programs, they're just going off one by one, and we are no longer in crisis mode. But then again, zero interest rate is essentially an affirmation that the Fed sees some sort of economic crisis still lingering in the background. So it's almost a little bit at odds with it.
I mean, that's a good point, Guy, because I've had folks come on and say, if everything is so great, then why isn't the Fed starting to raise rates? So there are still a lot of problems out there.
I think what the Fed is doing, they're kind of separating the problems into two camps. On one hand, you have these sort of economic problems, which are these massive pressures built up by housing and weak consumer balance sheets. On the other hand, you've got the financial sector problems and liquidity, which has improved dramatically over the course of the last year. So one set of those problems is solved, the other is still sort of playing out to one degree or another.
So, Guy, when do the knights around the round table down in D.C. start to say knee to the extended period language? When do you see that coming out?
Well, we're still willing to say that it's going to be out in the next couple of months, next couple of statements, because again, this extended period language, it just puts such a tight restriction on what the Fed can do. And because we don't have a great idea of what conditions are going to look like a year down the road, they need that flexibility ultimately.
So, I'm sorry, go ahead.
No. I was going to say, what do you think about the mortgage market? Where do rates go from here? Or 3 months, 6 months, 12 months down the road?
Well, this end to the Fed buying, the Fed, of course, is purchasing about $1.25 trillion worth of mortgage-backed securities. The end to this Fed buying has been really well telegraphed. I think the markets really weren't expecting it to be extended or expanded. The real concern here is if the Fed starts to consider selling some of these bonds that it has bought. And policy comments really in the middle of February or so implied they might consider selling some of these bonds later on this year. And I think that would really be the problem for mortgage rates. Until then, we've got a pretty good thesis for them to remain relatively stable.
Guy, what do you make of, and our Mike McKee talked about this earlier, about some of the members of the FOMC, starting to be kind of a little bit worried about keeping rates for so low for such an extended period of time. Tom Honig not only dissented, but he strengthened his dissent. He said extended period no longer warranted because it could lead to the buildup of financial imbalances and increases risks to longer-run macroeconomic and financial stability. So what do you make of some of that kind of debate internally at the FOMC?
Well, I think it's a very significant debate, and certainly one that needs to be had now. Sadly, it should have been had probably back in the 2003 timeframe as well. But it's kind of ironic that this also comes forth on a day when Citigroup, for example, is marketing one of the first CLO issues since the credit boom really started deflating back in 2007. So some of the same structures that caused the boom and in some respects built up the same sort of problems that later exploded, well, they're starting to come back on the margin. And I think it's very healthy to have that sort of discussion and be very much aware of a resurgence in some of those easy credit structures.
All right. Are you worried a little bit about the next 6 to 12 months?
On the margin, yes. In terms of economic conditions, the nice part here is that the sort of downside risks are lifting a little bit. The potential downside to our expectations is improving. So I think that gives a little bit more reason to be confident. But at the same time, with all the forces that have built up behind the consumer, there's not a lot of hope for huge amounts of economic growth.
Listen, I can't let you go without asking about the Treasury market. We did see some reaction after the Fed statement. I mean, what's your outlook here for Treasuries? What would you suggest to investors in terms of how to play the Treasury market, if at all?
I think the story right now is to try to look for intermediate durations. That's really the 4 to 5 year investment portion, because that's where the yield curve is steepest, and that's where you avoid the major risks of long-term inflation coming back in, say, several years down the road.
Hey, can I ask you quickly, though, since we got a few more seconds, what about munis? Because there's a lot being written right now about concerns within the muni market. Barron's had a big article over the weekend. Are you worried about some of the muni issues that are out there?
You know, in truth, municipal credit quality has been extremely strong for decades. There's lots of fundamental reasons to expect that it will remain strong. And despite the sort of headline-grabbing size of state budget deficits, most states are able to work through these problems pretty effectively, as we've seen in the last 2 years.
All right, that's interesting to hear. Hey, Guy, thank you so much. Guy Lebas, Chief Fixed Income Strategist over at Janney Montgomery Scott, and our own Rich Yamarone right here in studio.